Good afternoon, everyone. Thank you for joining us today. For many business owners, selling their company is a once-in-a-lifetime event. Our goal today is to help you understand the key steps to take when selling your business. Before we dive in, a quick word about us. My name is Greg McSweeney. I'm a portfolio manager at Crestwood Advisors. Joining me is my colleague, Luke Neumann, a wealth manager. Together, we'll walk through the financial, structural, and personal considerations that come with planning the sale of your business.
Thanks, Greg. Excited to be here and welcome to everyone. Just before we get started, we want to share a little bit about Crestwood for those of you joining today who are not yet working with us. We are a wealth management firm focused on helping our clients simplify their wealth and achieve their goals. We manage about $7 billion of assets for client households across the country and internationally, and have been consistently recognized by Forbes, Barron's, and others as a top investment advisor in the country. The focus at Crestwood is to serve our clients as best we can, and that's evidenced here by the wide variety of credentials that our colleagues maintain. Our approach has always been to provide holistic advice to our clients, and a key part of our work with many first-generation clients and wealth families is focusing on their businesses. After going through many transactions and liquidity events in recent years, we want to share some of the learnings and high-level guidance with you all here today. So today we're going to discuss the life cycle of a business transaction, from contemplating a sale on the left all the way through life after the sale. Typically, this is a process people only go through once during their lifetime. So it's a good idea to understand what might be coming your way down the road. Specifically, we'll cover what successful exits have in common, how to assemble the right team of experts, some types of wealth strategies that we see and actually commonly recommend clients employ, tax advice and ways to maximize the sale of your company, and finally, life after the sale. How do you maximize your proceeds for your legacy, for your family, and the causes that you care about? Just a note, we've geared this presentation to be relevant for founders and business owners, but I actually want to highlight here that a number of strategies we're discussing today can be used by early employees, executives, and investors, essentially anybody with a concentrated position in a business transaction.
So when looking at the timeline at the top here, we're starting on the far left at contemplating a sale. You as a listener or business owner might be at any point along this timeline, but we think it's important to think about some of these things from the beginning. So when we look at some of the most successful exits, there are some common threads. Not every business checks all of these boxes, but this is what we see as a list of best practices. Most successful business sales start with an owner who has strategically, over time, built the capacity of his or her business to thrive beyond their own contributions. They planned in advance for that. The leadership team should be experienced and aligned, everyone rowing in the right direction. Retaining a highly experienced leadership team can also inspire confidence in buyers and continue driving growth post-transition. The strength of the team often signals the strength of the business itself. Next, even if you don't have plans to sell, operating your business as a viable, sellable entity is just good business practice. We've seen that it creates healthy businesses when owners are continually thinking about the long term. The most successful owners in the sale with a clear vision of what success looks like after transition, both for them and for the business. Whether that's financial independence, more time with your family, or launching a new venture, having a defined next chapter creates purpose and clarity. Finally, it's critical that the owner has thoroughly assessed the timing, which we'll outline on the next slide. So we're still here at the contemplating a sale part of the timeline. There are three things that we think about, and we describe this as three clocks: your personal timing, the business timing, and just as importantly, the economic or the buyer's timing. When these three align, you have a foundation for a strong exit. So what are some of the considerations for each clock? First, on your personal clock, is there a successor to you in your business? Are you taking the right amount of risk with the company? Do your professional goals still align with your personal goals? Would a capable partner help propel the business forward? A lot of you might think about these considerations And it's important to think about these next two clocks as they relate to it. On the business side, we think about the following. Is the company performing well? Has it been growing? Is it at record profits? And do your margins validate the value you provide? What we mean by that is your business, if it's providing a lot of value to the customers, is that showing up in your financial statements? When an outside potential acquirer is looking to buy you, are they going to immediately see that? Or is there something that can be done in advance to improve those margins and set the company up better for a sale? Then on the risk side of the business, does your company have any debt? If profits decline, is it going to be difficult to service the debt? If your business has any cyclicality and you might have to invest in your business if it experiences a downturn, is that something that you're prepared for? Lastly, on the economic timing or the buyer's timing, some things that buyers think about are, is your industry growing? Are institutions actively looking to invest and buy in your industry? Are you getting inbound interest from buyers, which is usually a good signal? Is your industry becoming more competitive, or is it consolidating? And what is the industry asking your business to become? Anecdotally, we've all seen businesses that get acquired for a great price and a high multiple, largely based on the circumstances that are going on around them in the industry. And on the flip side, if the industry is going through some challenges or questions, coupled with your business growth or margins starting to inflect downwards, the appetite from potential buyers could be dramatically lower. We've seen businesses that have slightly slower or flat growth that could result in the sale price that might have been half of what it was just 1 or 2 years prior. So the earlier that you can contemplate the timing of each of these 3 clocks, the better prepared you'll be to act when the timing is as good as it can be. Now let's walk through some considerations for preparing to sell.
Thanks, Greg. I love the analogy of the 3 clocks there, right? So we're moving along the timeline here from left to right, contemplating a sale to preparing for a sale. So you perhaps identified that, in the coming year, 2 years, 3 years, that you're willing and able and ready to sell. Selling a business is complex, and having the right team in place is critical to achieving a favorable outcome. Each professional on the slide here has an important role in that transaction. First and foremost, there's you, the business owner, perhaps the controlling equity stakeholder. Your needs and preferences are going to drive this process forward. Right next to you is Crestwood. Crestwood is, our role is your financial advocate. We are a partner in your personal financial journey. We oversee the entire team, keeping your interests in mind and keeping every professional down below aligned. Might be easy to think of Crestwood as organizing your personal board of advisors. So looking down that level, who's on that board? So first is the investment banker. Markets the business, identifies buyers, negotiates the terms. Business owners typically only do this once. You want someone in this role who has sold tens or perhaps hundreds of businesses and knows what to expect and how to create and take advantage of conditions for the best sale. In an ideal circumstance, they can uncover potential buyers or potentially leverage connections for a more favorable price. And Greg, I think you had an interesting anecdote to share based on a recent experience here.
Yes, we had a client who had a great outcome. We introduced our client to an investment bank 2 years ago that ended up being integral to the success of the sale. They had some initial conversations a couple of years ago and then formally engaged them almost a year ago. This was a good example of preparing far in advance and how it made for a professional process. First, on the client side, the investment banking team laid out a deal calendar that was 9 months long and listed every major preparation milestone. This allowed our client to really understand the process of how it was going to go, and certain key points, the preparation really paid off. For example, the banking team ran a mock investor day. 2 of their colleagues who weren't part of the deal team that our client knew posed in character as potential investors and grilled our client with questions for several hours. This allowed him to understand what types of questions might be asked and what they cared about, and to really put his best foot forward in the higher stakes environment when the actual management meetings occurred. Then on the buyer side, the banking team handled all of the initial conversations. They contacted over 100 potential buyers. They gauged their interest in the space and where they were in the life cycle of their investment fund, all before even revealing the name of the business. They then narrowed that list of potential buyers down over time from over 100 to a list of a final 10 that were very interested buyers with whom they held those management meetings that our client was so well prepared for. This resulted in a bit of a feeding frenzy where the buyers were outbidding one another, and our client ultimately sold for 2.5 times what they thought and we had planned for the business being worth just 18 months prior. It was a phenomenal outcome, and largely owing to the investment bankers that ran the process.
Yeah, Greg, I just love that story. Really happy for those clients. So, moving on from left to right here, we have investment banker. The M&A attorney is next. So M&A attorneys are going to structure the deal, prepare purchase agreements. It's really careful to. It's important to carefully understand and negotiate the final terms of an agreement. There's a lot of value to be won or lost in the details. And just a quick anecdote around the attorneys involved in the deal here. We had an experience with a client who transitioned his sole proprietorship consulting business to a partnership. Right, he elevated a few of his key employees to partners in the business, and in this circumstance, working with a M&A attorney to carefully draft that partnership agreement, understanding all the components of the decisions that were to be made, that individual ended up being the most important role among the kind of 4 that you see here today. And so it's just to highlight that there's you don't necessarily need all 4 in every business transaction. Just one more comment about this transition process to a partnership. We actually loved this for this client, and there's 3 reasons why. So first off, and perhaps most importantly, they were able to monetize the asset. Right, they sold shares in the business and received compensation for it. 2, they created a pool of aligned partners for the business. Those employees who are now partners are out there creating enterprise value for our client and for themselves. And 3, this created a concrete glide path towards retirement. There's a clear and financially sustainable off-ramp for our client out of the business. So that's investment banker, M&A attorney, moving on to estate attorney, right? An estate attorney is going to ensure that your ownership of the business is optimized for estate and income tax planning purposes. This professional takes into account your personal and family concerns and integrates those with your ownership structure. We're actually going to speak a lot more about this on the next few slides, as there's a lot of pre-transaction work that can and likely should be done in many circumstances. Finally, bottom right, the accountant reviews financial statements, evaluates financial records. In all likelihood, you need a different accountant for audit and general M&A purposes than your ongoing bookkeeper and tax preparer. So on this page, we built the team that you're going to use to take you through the sale. There's actually another aspect of preparation that we want to walk you through. How are you going to prepare your personal wealth for this upcoming transition? There are several important estate and income tax planning considerations we think make sense to address early and likely often. So let's start with the ownership structure of your business. Gift trusts. Gift trusts allow business owners to transfer assets into a trust for beneficiaries, while also setting conditions for how that gift can be used. 2 common structures here are the Spousal Lifetime Access Trust, which provides indirect access actually for the business owner via their spouse, and the Intentionally Defective Grantor Trust, which moves assets out of the estate generally for the next generation. Both can be powerful ways to reduce estate taxes and benefit children or grandchildren. As we move shares out of a business into gift trusts, we need to know the value. Valuation is another key planning opportunity. Typically, a private markets discount can be applied when valuing shares in a closely held business. Because these shares are less marketable or represent a minority stake, they can be valued lower for tax purposes relative to the fair market value that we assume they're worth. This reduces estate and gift taxes, and we have an illustration on the next slide as to how gift trusts and valuation discounts work together. I know this is a little dense. We'll get to the illustration. So finally, philanthropy. For those of you who are charitably inclined, a business transaction represents a terrific opportunity to build up a philanthropic legacy. You can, in many situations, donate shares of private company stock, similar to how we donate public equity stock. There are a few reasons this is valuable, and it's fair to view this as perhaps doubly tax advantage. First, we're going to create an income tax deduction in the year of donation. Just like when we donate cash to a charity and receive an income tax deduction, you can receive a fair market value donation for stock. Second, and this is that double income tax benefit, second, we're going to avoid incurring the capital gains on the donated shares in the first place. So simultaneously, you receive a deduction and you lower the amount of gain that is recognized to you in the first place. In many situations, these donations go into a donor-advised fund. You can think about this as a pool of charitable assets that can function over many years as a sort of personal foundation without all the overhead and compliance of an actual foundation. So how do some of these, concepts work in practice? Let's look at the next page where we can look at a hypothetical to illustrate some of these concepts. So the following, is a hypothetical business again, right? So let's say you, the business owner, have a business worth a fair market value of $10 million. And for the purposes of this, illustration, let's assume that perhaps you have some other assets out there too. You maybe have some real estate, a brokerage account with investable liquid assets in it, other private markets investments, and likely some retirement accounts, right? So, we have the fair market value business at $10 million. We assume that this is going to grow over the coming few years. Perhaps you're optimistic about the opportunity for your business, or you see earnings growing already, or you see revenue growing already, and you're thinking about, moving out of the business over the next few years. So in this situation, we've identified that you likely have, everything that you need for your lifetime, right? And you're starting to think about how you're going to create that legacy for the next generation, right? So we're going to move 20% of your shares. And again, this is all a hypothetical number and individually planned, but for illustrative purposes, we're going to move 20% of your shares to a gift trust. Due to lack of marketability, that valuation discount I mentioned earlier, the gift is valued at a 35% discount or something similar to that, meaning you only use $1.3 million of your lifetime gifting exemption, right? There's $2 million of stock in an irrevocable gifting trust, and you've only used 1.3. Let's fast forward a few years. Your business grows and transacts for $30 million. Perhaps you engaged with the team members we highlighted earlier and had an opportunistic sale at $30 million. Congratulations to you. I'm very happy. That 20% gift, right, formerly $2 million, has grown to $6 million inside the context of the trust. So now, assuming, let's just for ease of illustration, let's assume this was an all-cash deal. There's an irrevocable gifting trust account with $6 million in cash in it that you can invest for the next generation. But you, the business owner, have only used $1.3 million of this exemption, meaning you permanently exclude $4.7 million of growth from any estate taxation. And, if we're thinking about federal estate taxation, right, the federal estate tax rate is currently 40% for assets over the exempt amount. And so, if we're exempting 4.7 million, you're saving $2 million on in estate taxes on this transition. So this is just to illustrate kind of some of the power that can come with some of the early planning and using gift trusts as part of your overall planning vehicle.
So on our timeline at the top, we're still at preparing to sell. There's a lot of preparation here. And just as Luke described mitigating some of those estate tax considerations, capital gains tax will be one of the largest expenses in your transaction. So planning is essential. We've laid out 3 categories here where pre-planning is important to reducing your tax burden. First is planning around qualified small business stock, or QSBS. There are some nuance here about which types of businesses qualify and what to expect. And we direct you to our website, where we recently published a piece that details what I'll touch on briefly here. At a high level, if you are the shareholder of a business, either the owner, employee, or an investor in a privately held business, and it is structured as a C corporation, it may be deemed qualified small business stock. If it is, and certain other criteria or considerations are met, then when you sell your shares, you can exclude the first $10 million of proceeds from capital gains tax, likely saving you between $2 to $3 million. Importantly, for larger sales, as we note on the right-hand column of benefits, you can engage in what is called a stacking strategy, where you can multiply that benefit by gifting portions of your shares. One example where we've done this is a client that Luke and I work with. When we started working with this couple 4 years ago, the husband held $10 million worth of stock in a multi-billion-dollar private technology company that he had briefly worked at several years earlier when it was valued much lower and still considered a qualified small business stock. We set up 2 trusts, a spousal lifetime access trust and a children's trust, and gifted a third of his shares to each of those, keeping a third in his name. Fast forward to today, and the business value has grown substantially, such that that $10 million of stock is now worth $25 million. And were it sold today, the family would pay 0 capital gains tax. We like this example because it's very easy to accomplish and can be used for both business owners, employees, and investors. But often we find a lot of our clients and a lot of individuals are unaware of this strategy. Next is tax loss harvesting. This is the act of selling something at a tax loss. In the year of a transaction, you're likely going to have a very large capital gain. And so what we like to do is pre-plan for that by implementing strategies that are more efficient at generating tax losses. There's a couple different ways to implement this, and we encourage you to reach out to us to discuss in more detail. But particularly in advance of a transaction and in the year of a transaction, those losses do not expire. If you have net losses that you've accumulated years in advance, those can all go towards offsetting the gain you experience on the sale. And then there's some unique strategies once you have the proceeds, and you might have 9 months left remaining in the year if you sold your business at the end of March, where you can do some planning to further offset that capital gains tax bite for the remainder of the year. And likewise, for following years, if you sell a portion of your business and perhaps keep a portion or roll a portion of your equity, maybe 20% of the business you contribute to the ongoing entity, there'll be a future capital gains tax associated with that sale. And there's a lot that can be done to offset that gain and potentially eliminate that gain over time. So lastly, we did want to call out stock options, RSUs, founders' shares, and profit interests. And as Luke mentioned at the top of the webinar, you might not be the owner of your business, but you have some form of ownership through one of these options or types of shares. There's a lot of pre-planning that can be done in thinking through how to minimize your tax bill, and we encourage you to reach out and have your Crestwood colleagues work through some of these considerations. So now we're moving from preparing to sell to navigating the sales process. There's a lot on this page, and I think it's important to note that not all transactions look like this. We have at the beginning, connecting with potential buyers and managing negotiations. That might come later in your process. At the end, you're closing the deal. But importantly, assembling the team and thinking through this in advance, you'll be well prepared for meeting each of these milestones, understanding how it's going to work, and knowing that you've run the right process for what might be something that you only do once in your lifetime, and is a big portion of the value that you'll generate. So not a lot to say specifically on each of these steps here. I think that each of these processes are different, but preparation again is key. And I think we can then move on to some of the maximization of the proceeds associated with that sale and after.
Yeah, 100%. Thanks, Greg. So we're moving on here from the deal to maximizing proceeds, kind of assuming the deal has closed, right? There's a lot of considerations that we work with our clients on, and these listed out here are just some of them. And I just want to highlight a few for you here today. So, rolled equity, right? So this is one of the most common features of a sale to a strategic entity or a private equity firm, is that either the buyer wants you to roll equity or you allow elect to roll equity into that new firm, right? And perhaps you say, I'm going to hold back 30% of my business in terms of rolled equity. Typically, hopefully that's you're going to get a more favorable outcome a couple of years down the road when the business transacts again, right? So there's a few considerations here, though, right? You have to plan for future tax impacts. The tax loss harvesting that Greg mentioned can actually be really valuable in terms of building up a pool of tax losses for that future capital gain. Second, investment and liquidity considerations, right? Is the steward of your business that you're selling to the company that you want to be, your most significant investment to be in, right? Do you want that rolled equity to be, stewarded by that firm? There's also investment and liquidity considerations around that too. How are we building your investment portfolio to compensate for the risk that you continue to take in the business? Perhaps, that we can identify that risk as a next generation legacy building event, or perhaps we know that you need some of those funds to support your lifestyle, and we should take perhaps a more conservative approach in your personal investment portfolio. Tax budgeting is, first and foremost, a consideration here when you go through a deal is better understanding, safe harbor rules. How much do you need to pay this year? How much can you defer until the tax filing deadline for your area? How are we going to escrow that tax payment in a smart way, right? We want to make sure that you're earning the maximum interest, but have, minimal risk of losses in that tax escrow account. And finally, consider spreading income over a few years. Both on the capital gains and ordinary income front, we have a progressive tax code in this country. Installments and earnouts can move some of that income into lower income tiers, right? Either capital gains or earned income lower tiers. So loss harvesting after a sale. So this would be to, accelerate, let's say you sell your business in June, you still have 6 months of the year, which is going to show up on the same tax return as the sale of your business here in June, right? Can we harvest losses through the end of the year, thereby minimizing the amount of taxes that you're going to owe on the sale of your business? And so this can be actually really powerful, and probably the first best time to sell your business is when you can get the best price. The second best time to sell your business would be January 1st, so you can loss harvest all year long to get to reduce that tax bill. Long-term planning, we want to align that asset allocation, of course, with, your personal goals, your personal spending plan, your personal legacy plans. And, where possible, we're going to start incorporating alternatives, both liquid and drawdown funds, where it adds value to client considerations. I think employment is probably an under-discussed feature of going through these transactions, right? Is what are you going to do next, right? A lot of business owners will focus, kind of really focus on the deal, getting the best price, and what comes next will be a little bit of a gray area. And it's not necessarily a mistake, but it's an under-discussed area of going through a transaction like this. Are you going to continue working in the business? If not, are you intending to, how are you intending to spend your time, right? Is there another idea you have? Would you going out and get a job? Or, are you planning to kind of sail off into the sunset, spend more time with family, spend more time building that legacy? So, and finally, philanthropy, I can't highlight this enough for those of you who are charitably inclined. The earlier you start thinking about, building that philanthropic legacy, building those charitable assets, how you're going to use those charitable assets, perhaps how you're going to engage your family in a charitable giving exercise, the better your outcome is going to be. So these are just a few of the considerations that we get asked or think about for our clients, around the deal and after the deal.
So we're wrapping up soon here with the life after the sale, and just wanted to encourage, if you have any questions, to enter them now into the Q&A. The box you might see at the bottom of your screen. Life after the sale, I think Luke touched on a lot of those points, both whether it's employment, or you can continue with your business and grow it, or you're going to start something new, or philanthropy. One that that actually comes up occasionally, and we're privileged to have the opportunity to engage with our clients, is often a client that has a large life-changing transaction. It cements their financial legacy and that for their kids and potentially grandchildren. And they would like for us to discuss with their kids and sometimes grandchildren what this now means, and what the expectations are for the future. So oftentimes they'll turn to us and say, we're a professional firm that can contextualize that for the kids and discuss long-term investing, can discuss philanthropy, can discuss various goals. We feel, as we said, privileged to be in that position, and it's often a good outcome where it helps set up a setting where our clients can talk through that with the next generation. I think we have a couple of questions in the chat here, but we'll also encourage you to ask a couple more. First is, go ahead.
Yeah, I think this would be good for you. How do I know? Here's a question from the chat. How do I know when it is time to sell my business?
Yeah, so as we talked about earlier, we do think about that 3 clocks. So you might be thinking about retiring on a set time frame. Maybe it's 5 years from now. You're approaching 65. We'd encourage you to think about the business and is it ready for that sale, and then also be ready if the industry changes. This is going to be a different consideration for every client, but it's important that I think we can't stress enough the preparation. You might want to engage with initial discussion with an investment banker 3 or 4 or 5 years before you might sell. Often investment bankers will have multiple discussions. There's no financial obligation for you. You don't have to sign any paperwork. They're doing their own business building. But we've seen that with clients that might say, I've still got a lot of gas left in the tank. I want to work for a while. And how about this idea? I might go acquire a business. And with that, what would that do for my business value? Would it grow it? Would it distract from what a potential buyer might want to buy? We've seen that happen, and we've entered into a lot of those initial conversations where our clients gain a lot of value from the insights of the professionals that lead these transactions, and importantly, know what buyers are looking for. So we'd encourage you to start early there.
Thanks, Greg. Yeah, we got a great comment in here, around the QSBS exemption and some of the changes that took place with the Big Beautiful Bill that passed on July 4th this summer. I think this is an important one to highlight, right? Greg, you mentioned that qualified small business stock is exempt from $10 million of capital gains per tax ID, right? In the situation you gave, we kind of created 3 trusts, one personal trust, 2 gifting trusts, stacked it for 3 times $10 million. For businesses, or rather for shares that are purchased, original issue shares that are purchased after July 4th of this year, that $10 million exemption is actually going to be $15 million. So it's important to highlight that this isn't going to be in effect for the next 3 to 5 years, right? You have to actually have that 3 to 5 year holding period. But for original issue shares that are purchased here after July 4th, there are some other considerations too, right? $15 million of exemption instead of 10, and there's a rolling period of 3 to 5 years where the exemption increases from 50 to 100%. I think that's a really great comment that we have here in the chat.
So it looks like we're kind of wrapping up. No remaining questions here. We've kind of answered some repetitive questions, but we wanted to thank you all and direct you to our website or your Crestwood team if you don't work with Luke or I with any questions you have. Thanks for the time today, and we look forward to speaking with you.
Thank you all.